And this is Bloomberg Technology. Coming up in the next hour, Netflix shares surge in late trading as subscribers beat estimates. A welcome surprise after last quarter's dismal results. Will the video streaming giant boost other lagging tech stocks? Plus, IBM's revenue miss. We survey its move to the cloud in a market dominated by Amazon. And hitching a ride for an IPO. Morgan Stanley and Goldman Sachs are said to be pitching to underwrite Uber's public offering as Lyft reportedly chooses JP Morgan to run its own. First to our top story, Netflix shares rallied in late trading after the company crushed third quarter earnings. All eyes were on subscriber growth, and results easily topped forecasts. Netflix had projected 5 million additions and reported 7 million globally. It was a record for the third quarter, up 31% from the last year, and it appears Netflix's record-setting level of new programming is paying off. The company released 676 hours of new TV shows, movies, and specials in the latest quarter, helping to attract those new subscribers. Joining us now from Boston, TrueOptic CEO Andre Swanston. TrueOptic runs an audience measurement and data management platform that works across the over-the-top ecosystem. Also joining from LA, Bloomberg's Lucas Shaw, who covers the company for us. So, Lucas, pull out the highlights here. Obviously, subscribers far and away beating estimates. Also, the forecast for subscribers beating estimates, but the earnings forecast a little bit light.
Yeah, I mean, the thing with Netflix is that the investors always look at the subscriber number. It doesn't seem to matter what's happening with the revenue or their earnings. By and large, the revenue story for Netflix has been one that's pretty positive because they are boosting the amount of revenue that they get per subscriber, which means that each subscriber that they sign up should be a kind of a net positive for them. But the takeaway, as always, is the subscriber number. They're on pace to add almost 29 million customers this year. I went into this quarter thinking it was possible that they would report a decline in subscribers this year if they had a miss. Instead, they're going to post their biggest year ever by about 5 million. At a certain point, you run out of superlatives to talk about the growth, at least in terms of customers, this company is delivering.
So, Andre, when you look at the data across TrueOptic, what do you believe is driving this? Is it these new Netflix original shows?
No, I don't believe it's the new Netflix original content at all. I think there's a certain, part of the success of Netflix that can be attributed now, definitely over the last few quarters, to just a rising tide, floats all boats. The growth that we're seeing across over-the-top and connected TV, not just domestically in the U.S., but in pretty much every broadband, internet-connected, market in the world is just phenomenal. And I think at some point, the street has to stop looking at Netflix from the standpoint of just did they hit or miss their own estimates in terms of what growth is going to be, and really just look at it as a normal company. I think there's three things that I would be really worried about in terms of the future if I was Netflix, regardless of really whatever the story was this quarter, and that would be AT&T, Disney, and then free OTT solutions. The value and the demand for the content that HBO and the Warner Media will have when they launch their solution, Disney content, and then just the massive growth of free ad-supported OTT is even more significant, I think, than what we're seeing from Netflix the last few quarters.
Lucas, given that Netflix is so far ahead of other streaming providers at this point, do you share those concerns that it's about AT&T, about Disney, and other free over-the-top competitors?
I think the free one is not really a concern for Netflix. They've competed for the last 10 years with a pretty popular free ad-supported service called YouTube, and both companies have done just fine over that period. The competition from Disney and from AT&T is very real. Those two companies have huge troves of library that's very popular. They're both going to be pulling back movies and TV shows from Netflix to boost their own services. The Netflix counter would be that, one, that they've been building a studio over the past few years. It's something they talk about in their letter to shareholders today. And their biggest hit as an original show, Stranger Things, is something that they made themselves. It's not something they got from another studio. And then to Andre's own point about sort of a rising tide, I think you can see AT&T and Disney grow without it necessarily hurting Netflix. There'll be a lot of competition in the developed Western markets. But I think overseas in particular, Netflix is going to be really far ahead of those companies, and I don't know how much of a threat they'll be in a place like Brazil.
I'm looking at a chart right now on the Bloomberg Top Live blog where we're following Netflix results. This is a chart of Netflix margins, which appear to be very strong, Andre. That said, if it's not a result of the original content investments, are those investments in original content worth it? Because Netflix is warning about its negative free cash flow, and it has a note in its results today to investors that they recognize they're making huge investments in content, but that they believe this investment is worth it and will pay off over the long term. But is it?
The team at Netflix is very intelligent, and they saw, kind of the economies of scale changing 3-4 years ago when they really started to make their investments. So, Netflix knows they have no technological barrier to entry. So at some point, with just the proliferation of OTT and connected TV, the providers of content that they rely on would eventually bring that in-house, and that's really why they've been preparing this original content strategy for quite some time. So what I will disagree on, though, is, looking at YouTube, which with the overwhelming majority of the content is user-generated as competition is really, not viable. Now what you're seeing across free ad-supported solutions, whether it's, Pluto TV or Tubi TV, is high-quality, professionally produced content licensed from the MGMs and the Sonys and the Warner Brothers and others. And that's where domestically in the U.S., the majority of the unique household growth has been over the last 20 months or so. And then in international markets, it's really not so much having to worry about the Disneys or the AT&Ts. It's the Globo TVs in Brazil that own all the popular telenovela rights, or the iFlix in India. And Netflix has had problems competing in these markets. And so my concern is, in order to compete on 100 different fronts at once and having original content in the native languages and different genres, the amount of money that Netflix is going to have to spend on content over the next few years is just, it's so unprecedented that I would be concerned if I were at Netflix.
Right, and international is where the growth is coming from right now, but can they keep it up? Andre Swanston, True Optics CEO, and Lucas Shaw, Bloomberg News. Thanks so much, Lucas. I know you're going to be listening into the call happening momentarily. Staying with earnings, shares of IBM dropped in aftermarket trading as third quarter revenue missed expectations. IBM made $18.8 billion. Analysts were expecting closer to $19.1 billion. This comes as IBM continues to shift its focus to its cloud division, where revenue rose by 10% to $4.5 billion. Joining me now from New York, Bloomberg Intelligence senior analyst Anurag Rana. So Anurag, why the miss?
There were a couple of things we were expecting and a couple were unexpected. The company goes through every 2 to 3 years for a mainframe refresh cycle, and that anniversaries. So with that, you would see the growth come down a little bit. But there's a particular division called Cognitive Solutions, and that's where we saw some growth go down to, I think it was -5% in constant currency. And the positive side was there's a division called Global Business Services that grew about 2%. But I think it's that 5% decline in cognitive that is, in our view, a little bit alarming, because that's where a lot of the Watson-related technologies sit. And we would want to know on the call as to what was the reason why we saw such a decline in that particular segment.
So let's talk about the cloud. Obviously, IBM continues to unveil new cloud products, but they got to the cloud revolution late. Can they catch up?
So there are two ways to look at it. One is the public cloud solutions, which is Amazon Web Services or Microsoft Azure or Google Cloud Services. What IBM wants to do is modernize their older clients that are usually on-premise or mostly on-premise, and they want to move their applications and data to the cloud. That's more of a hybrid cloud strategy, and the strategy is all right over there. But the problem is those companies take a long time to move their portfolios to the cloud, and also in that area we think Microsoft has an edge over others because it has somebody that has a very strong public cloud presence, and it's also present in the enterprise.
IBM shares still struggling over time. Is this something that Ginni Rometty can turn around?
See, again, I've said this for years. They have made some of the right investments in the area, but the competition is so tough from some of very, very large vendors out there, and they have a fairly sizable legacy portfolio of products. So you got to be patient with this particular element. But that 5% decline in cognitive is something that's a bit concerning, because that's where some of the next-gen technologies are that are Watson related, and some of the software products are.
All right, Anurag Mana, Bloomberg Intelligence will continue to follow IBM results as they roll out as well. Thanks so much. Coming up, two of Silicon Valley's most anticipated IPOs sparked chatter on Tuesday. The latest details on Uber and Lyft's potential 2019 initial public offerings next. This is Bloomberg. Now to the IPOs that could be hitting the road. Uber has received proposals that value the ride-hailing service at up to $120 billion in a public offering. That is nearly double Uber's valuation from just 2 months ago. Goldman Sachs and Morgan Stanley reportedly delivered the proposals last month. That wasn't Tuesday's only IPO talk. Lyft also has selected JPMorgan Chase to be the lead underwriter for an IPO expected in the first half of next year. Lyft's valuation is expected to top the $15.1 billion it was valued at earlier this year. For more, I want to bring in Bloomberg's IPO reporter Alex Barinka and, of course, Bloomberg Tech's Eric Newcomer, who covers Uber and Lyft for us. So, Eric, what do we know about both of these IPOs?
They're coming. They might come right on top of each other early next year, probably the first half. Even though, Dara Khosrowshahi, Uber's CEO, has been saying sometime we're targeting the second half of next year. I think they're both in a hurry to get out, and it looks like they could be sort of right on top of each other.
Really? So I thought Lyft was going to be first. Isn't that what we expected?
Strategically, that made sense for Lyft, but it seems like Uber might be trying to kind of rain on that parade. The tough thing for Lyft is Uber's the bigger company. They are in more things. And when Lyft goes out, I bet the questions will be from investors, what comes next? They have that core ride-hailing business, but look at Uber. They have food delivery. They have scooters. They have all of these other things. Lyft wanted to head off some of those questions by getting out first, but if Uber jumps the gun and pulls the trigger, they could not only cause a narrative problem for Lyft, but they could also cause a wallet share problem for Lyft, and that investors want Uber shares and not Lyft shares.
$120 billion valuation, though.
Right. So that is sort of the headline, what bankers are selling Uber. Maybe if, we lead your IPO, we could convince the world that that's what you're worth. So I think there'll be a lot of questions.
Be careful about that.
Right. They're setting a high expectation,
Yeah.
Yeah. Lyft, we have a target of around $25 billion relative to a sort of $15 billion last round valuation. That seems more plausible. But with Uber, the defense is, they have their ride sharing business, which is global. They have stakes in Didi, Yandex, Grab. They have a huge autonomous business. They have a food delivery business that they believe is bigger than Grubhub. You pick up all the pieces together, and then you start to have this story for why it's this huge company.
Talk to us about the politics of the banks here, because JP Morgan doing Lyft, that means they won't be part of Uber's IPO.
That's right. In the banking world, it's called being conflicted out. So Uber had kind of hoarded these relationships under the former CEO, Travis Kalanick. They'd said, if you work with us, you can't work with Lyft, or else you're not getting another mandate with us. So JP had actually been working with Uber for a while, but I guess they looked at the layout and assumed that Goldman and Morgan Stanley would end up with the lead roles over at Uber. That means a smaller fee share for JP Morgan. JP Morgan's consistently third behind those two other firms. So nabbing a lead left #1 slot on what could be one of the biggest IPOs of the year in the tech space is a good look for them. So that seems to be some of the behind the scenes machinations going on right now. And for Lyft, what I was told is if they get one of the top 3-tier banks, they're out the door, and it seems like that's what's happening.
So how is SoftBank going to play into this? Obviously this is, the international story that's developing by the second, but there's a lot of concerns now about SoftBank's connection to Saudi money, despite the fact that the Saudis continue to deny, that the government continues to deny that they are part or behind the disappearance of this journalist.
Right. I think at this point, Uber has the money. So much of the money they have is tied to the Saudis. They have $3.5 billion directly from the investment fund. So the SoftBank is only a small part of their trouble, and I think it's about managing those relationships. Obviously, I'd love to be in the board meeting where they have to sort of have it out over Dara Khosrowshahi's decision to leave the Saudi forum. But I don't think they can give the money back at this point, and so I think it's just sort of keeping their distance while realizing that they have a Saudi board member.
Though there are reports that some other companies like Endeavor are considering that.
Right.
Are there broader concerns in the ecosystem among investors about the connection that SoftBank has to now so many companies in the tech ecosystem.
I hate to say this because the moral conundrum is so huge, but I question whether or not public market investors will look at this and say this is a problem. If the board, being on the board and having that kind of say in the boardroom, that could become a governance issue. The fact that they took the money in the past, I think less so. So, I mean, Uber's stake that they had, to Eric's point, is a lot bigger than the $400 million that Endeavor had. It's in the billions. It's harder to kind of give that back. But you know what? For public market investors, my gut says they're going to buy into the story of the company, and they're not going to care so much about these kind of broader governance issues, again, unless something comes out again, or if the execs align behind the Saudi government.
Right, and of course, still waiting for new information there. Eric Newcomer, Alex Barinka, thank you as always. And good job with your scoops. Coming up, with cryptocurrency and cashless retail on the rise, tech is changing the future of money. An online finance company, SoFi, wants to make sure you manage it well. How it's using technology to improve our relationship with money, next. And Bloomberg Tech is live streaming on Twitter. You can check us out at Technology, and be sure to follow our Global Breaking News Network TikTok on Twitter. This is Bloomberg. Bloomberg Sooner Than You Think conference brings together the companies, entrepreneurs, and investors whose technologies are changing the ways we spend, save, and invest. From AI robo-investing to cashless retail, technology is rapidly affecting our relationship with money for both the better and, some say, the worse. One finance company, SoFi, is betting it can improve this relationship. SoFi offers a variety of online lending and wealth management services, providing everything from student loan refinancing to MBA loans. Bloomberg's Caroline Hyde sat down with SoFi CEO Anthony Noto at the conference to discuss.
Our mission is to help people achieve financial independence and realize their ambitions. And financial independence isn't about being rich. It's about having enough money to do what you want. For some, that's having enough money to have a family. For others, it's buying a house. For some, it's changing their career. And in order to do that, we have to help people get their money right, which means it has to be across all of the activity they do, from borrowing to saving to spending to investing and protecting. And money is a core element of, obviously, spending, savings, and earning.
When you talk about adding the checking account to a certain extent, when you're talking about also the other areas you're adding to, wealth management, for want of a better expression, to your user base, this is a competitive landscape. It's not only served by banks, but it's also served by startups as well. Where do you see the hottest competition coming from?
Yeah, we think we can really differentiate ourselves by not just providing those 5 different areas, but also focusing on other things that our members want. So we provide member benefits beyond just the financial products. So we have financial advisors. We also have career coaches through a partnership with Korn Ferry. We have social events for networking both professionally and socially. And so we want to build out a complete value proposition that's about the member at the center of what we're doing. And we think that's a key point of our differentiation, in addition to making the product faster, giving broader selection, better content, and then, of course, convenience.
Interesting, you talked about the money raised, $2 billion. A big chunk of that came from a financing round led by SoftBank. Now, SoftBank is in the firing line to a certain extent because it's built up the Vision Fund with Saudi Arabian money. How important to you is it about where the money you get is sourced from?
It's very important. We're very proud of the investor base we have. It's a great honor to be part of the SoftBank family and having them as our largest investors. And Masa's son has been incredibly successful from an investment standpoint, but also an entrepreneur and innovator, both at SoftBank and the types of investments he's made. So it's a huge asset to us to have SoftBank and to have Masa's son as our largest investor. And so we couldn't be prouder of that. And we want to make sure we're aligned with investors like Masa's son that have the same view on the long-term opportunities as us and that are willing to make large investments to capture that opportunity.
Talking about speculation, let's talk about the world of cryptocurrencies, because it is something that you're looking to offer by 2019. I want to understand about the overall technology also that drives crypto, which is blockchain. Is this something that you're looking to integrate within yourself to make loans quicker, to use that sort of technology at all?
Yeah, over the long term, we'd love to partner along with those that are investing in blockchain. I think blockchain has a lot of opportunities to wring out inefficiencies in the financing world. It would be great to be in a position someday where that we approve a loan and fund a loan simultaneously and also sell that loan. And so if we can approve a loan, fund it, and sell that loan simultaneously, then the amount of capital required goes down dramatically. The cost of capital goes to zero, and that will allow us to give better value to our borrowers and lower rates.
And the culture was something that you really were tackling. How do you find that evolving at the moment? Because, of course, when you took the helm, there were concerns about sexual harassment allegations under the previous leadership, and indeed, perhaps a toxic culture. That's something that's not just privy to SoFi, it has been something across Silicon Valley. How have you tackled it as a leader?
I couldn't be prouder of the progress we've made in the cultural front. I really wanted SoFi to be a mission-driven company. We've established that mission. The company embraces that mission. And then secondarily, we wanted to build a world-class culture. We want to have the best culture in the world. Part of building a world-class culture is defining what values matter the most. And we as a company defined 11 core values that we think will make us build the foundation of one of the best cultures in the world. The only thing that's standing between our company and being the best culture in the world is us, is leadership. It doesn't require capital, it doesn't require technology, it doesn't require IP, it requires leaders and a team that's committed to building a foundation of a great culture. And the core values is the starting point of that, and it's something we have to live every day.
SoFi CEO Anthony Noto there with Bloomberg's Caroline Hyde at Bloomberg Sooner Than You Think event in New York. Well, Microsoft co-founder Paul Allen passed away Monday at the age of 65 after battling non-Hodgkin's lymphoma. Allen, who founded the iconic tech company alongside fellow billionaire Bill Gates, went on to become an esteemed philanthropist, real estate developer, and sports team owner. He also leaves behind a legacy in AI. I spoke with AI expert Kai-Fu Lee, who also worked at Microsoft for many years, at the Wired 25 Summit about Allen's contributions.
I'm deeply saddened because I think he was one of the giants in the tech industry. That his partnership with Bill and what Microsoft did was tremendous. And after Microsoft, he went on and did interval research and the Allen Institute for AI, both of which had a lot of friends, and very saddened by that.
What were the sort of values he was committed to when it came to AI?
It felt like it was about openness. It was about sharing. It was not about building an empire. And I think, and he did it quietly. It wasn't like he was, beating his chest and telling the world what a great person he was. He just felt this was the right thing to do. And he hired great people, and they were on a great path, and hopefully they'll be able to continue.
Paul Allen was just 65 years old. Bloomberg Technology. I'm Emily Chang in San Francisco. Back to our top story. Netflix came roaring back this quarter and sees better things ahead. The company forecasting it'll add 1.5 million paid subscribers in the U.S. alone this year, almost twice the number from last quarter. With 58 million subscribers, they're well on their way to half of all U.S. households. Joining us for more, Paul Verna, principal analyst at eMarketer. Now, Paul, despite these stellar results this quarter, we had a guest earlier, Andre Swanson of True Optic, who is very concerned that Netflix will not be able to keep this up in 100 different markets around the world, different languages, and continue to produce original content to sustain all of them. Would you agree?
I don't think I would agree with that. I do think Netflix has challenges ahead, and they do include tailoring the content for some of the markets that they serve. Some of them are not English-speaking markets, and they've traditionally had more strength in English-speaking markets. So they do have their work cut out for them. But I think that Netflix, with these results and with other great quarters, excepting the previous quarter, they've really just knocked it out of the park and shut down a lot of the naysayers. And considering some of those challenges, I'm overall very optimistic about their future.
Okay, that said, given all the rising streaming competitors, whether it's Disney or AT&T or Apple, and of course Amazon and Hulu catching up, can Netflix sustain its lead? How does the battlefield essentially change?
Well, Netflix has been the leader in this space for a very long time, and companies like Amazon, like Hulu, and some of the other ones you mentioned have definitely ratcheted up competition, but they really have not come even close to catching Netflix in terms of its penetration, the number of shows it's producing, and its overall leadership in this space. Looking long term, it's possible that one of them catches Netflix, but in our forecast horizon, which goes out to 2022, we really just don't see that happening. We see Netflix continuing to be the leader, not just in the US, but globally in terms of number of subscribers.
So I do have a chart here on my Bloomberg from the Top Live blog where we're following Netflix results, which breaks down international and US subscribers. Where do you see the future growth then coming from?
Well, the future growth will continue to be outside of the U.S. That's been the case really for several quarters on the subscriber side and more lately on the revenue side as well. So that's really the focus for them. And the reason is pretty simple. In the U.S., I won't say they're saturated, but they're getting closer to that ceiling of what the growth potential might be. But there are big markets outside the U.S. where they're not nearly as far along the path of penetrating those markets. Certainly in Asia, India is a big focus for them. But even in Western Europe, where they have quite a bit of strength, there are big markets like Germany where they still have quite a bit of room to grow. And then there's Latin America where they've made lots of inroads, but there's some big populations in those countries that I think they still have a lot of ramping up to do.
All right, Netflix out with a strong quarter and a strong forecast. Paul Verna of eMarketer, thanks so much for stopping by. Coming up next, we have a chance to reset world equality thanks to AI. That is what Sam Altman thinks. We'll find out how he believes we can accomplish that in an exclusive interview. Plus, a different kind of unicorn in Silicon Valley, a venture capital firm dominated by women. Forerunner Ventures partners join us to talk about their latest $360 million fund. This is Bloomberg. When it comes to developing the next wave of tech startups in artificial intelligence, one person is at the center of both. He's the president of seed accelerator Y Combinator. Among its 1,400 tech investments are Dropbox, Airbnb, Stripe, and more. And he's also the co-chair of OpenAI, a research company with a stated mission to make sure humans and AI can safely coexist. So who better to ask about when the AI wave will arrive? Well, no one but Sam Altman. Here's what he told us at the Wired 25 Summit.
I think it's a question of timeframes. Like, I view the next few decades for this sort of most important technological milestone in human history, I view that as right around the corner. And so the debate of is it 10 years or 100 years, I don't think that matters too much given the magnitude of what's happening. Like, it's coming soon enough and it's a big enough deal that I think we need to think right now about how we want this deployed, how everyone gets to benefit from it, how we're going to govern it, how we're going to make it safe and sort of good for humanity.
Do you think that AI will share our values?
We have a team working on that right now. So how we impart human values, which are difficult to encode in math, right? So like, how do we teach a system our collective human values? And I will say I'm more optimistic now than I was before that we will be able to accomplish that goal.
Well, and do we even want AI to share our values? Because, you know, there are many inequities that exist in society that we may not want to be replicated in AI.
One of my hopes for AI is that it will take, it'll help us be our best. It'll help us like amplify our best and stop our worst impulses. So I think we have a lot of known psychological flaws. We have deep inequities in the world. And I think that AI is going to be a way where we can decide what's good and make sure the AI honors that and keeps that and that fundamental, because there's a lot of good in us as well. And the injustices I think we'll be able to address.
Elon Musk, who founded this with you, has been concerned about the sort of apocalyptic possible future of AI. How realistic is that apocalypse?
I think it's always hard to say, like, when you have any incredibly powerful new technology, here's exactly how it's going to go. I will say that I am personally optimistic we are going to get to the good future, but I think that's going to require incredibly hard work from very talented people that needs to start now.
So how big a risk is it that that work doesn't happen, or that AI gets off track, or that AI supersedes human intelligence and then has a mind of its own?
One thing that a lot of people worry about is that, some kid in a garage is going to invent AI by him or herself, and then misuse it or not think through all the safety issues. And one thing that I've become more confident about is that that's not going to happen. And the reason is that this requires truly massive compute resources, giant data centers, custom-built chips. And so I think we'll know all the projects in the world working on it. Some will be government, some will be private, some will be like us. But my hope is that as we get closer and closer, those projects will come together and make sure that we're thinking about the safety and the control issues.
In looking towards the future, there's some concern that artificial intelligence research and development has hit a wall, and that we need a radically different approach to achieve the breakthroughs that we were hoping for. Would you agree with that?
Not at all. I think if you look at the landmark result in the field each year for the past, say, 4 years, it's incredibly more impressive every year. It wasn't that long ago we couldn't even beat Go with AI. And now we can beat incredibly sophisticated video games with hundreds of thousands of actions taken with thousands of options at each step. And we have made algorithmic progress each year. We've also made incredible hardware progress. Every year we can use 10 times more compute power per deep learning model. The rate of progress is incredible, and that's going to continue.
So you recently had a team of bots play against some of the best human players in Dota 2, but the humans still won. Is that a setback?
No, I don't believe they'll win for much longer, and this is how it works. Every month we get better and better, and that just the rate of, I think basically every 2 weeks our bot has a 90% win rate against the bot from 2 weeks ago. So the rate of improvement there is just unbelievable.
So what's underhyped in the discussion about AI?
Well, I think people talk about sort of self-driving trucks and the impact that's going to have on jobs, and that's true. But what they don't talk about is all of the white-collar work that AI is going to do. My belief is that all repetitive human work that doesn't require the deep emotional connection between two people, that will all be done in the next couple of decades, better, cheaper, faster by AI. And that is somehow left out of the conversation. It's always about factory robots and self-driving cars.
What's overhyped?
The killer robots thing gets overdone.
No robots are going to eat all our jobs or kill us? Or
some robots will eat some jobs, and some robots will kill humans. You've already seen that with self-driving cars. But when you look at the trend as a whole, I think it's going to be incredibly positive for humanity.
But you do believe that AI can supersede human intelligence?
I believe it absolutely will. There's a big debate about timeframes, but I believe that I think it takes unique human arrogance to believe that AI cannot supersede humans.
But what about that scares you?
So many things, right? This is what does it mean to build something that is more capable than ourselves? What does that say about our humanity? What's that world going to look like? What's our place in that world? How is that going to be equitably shared? How do we make sure that it's not a handful of people in San Francisco making the decisions and reaping all the benefits? I think we have an opportunity that comes along only every couple of centuries to redo the socioeconomic contract, and how we include everybody in that and make everybody a winner, and how we don't destroy ourselves in the process is a huge question.
You've shared some controversial thoughts about universal basic income. How is the work you're seeing in AI impacting your view of social inequality?
Well, one is that I think the social inequality we have today is nothing compared to what we could have if we don't address it, because AI will just be such a powerful lever. Two is that I think we do have an opportunity, as we rewrite the social contract, to think about how we can get towards a more equal world. We'll never get all the way there, of course, and human flaws run deep. But I think we're going to have an opportunity to push the reset button and think about the world we want. And I think universal basic income is one part of that. But how we give I don't know what to call it, universal basic meaning. Mm-hmm. We'll have plenty of resources for everyone, but then how do we make everyone happy and fulfilled and find their purpose? We get to find out.
You're still spending half your time at Y Combinator. What trends are you seeing when it comes to the value of startups that are being created, the valuation of the startups that are being created, and whether it's worth it.
I made this public bet 3 years ago, 4 years ago, something like that, when everyone was saying there was a bubble. And I just looked at it recently. It's looking pretty good. And at the time, everyone was like, "This is ridiculous. You're going to lose the bet by far." And everyone was saying there was a bubble, so I suspected there wasn't. Now, most people aren't saying there's a bubble, and so I'm of course nervous. Everyone's now operating back to operating mode where everything's great, everything's going to keep going up. So I'm much more nervous than I was when I made that post. I think it was 3.5 years ago. I try not to get too focused on bubbles because I try to keep this multi-decade view. And I want to invest in shares that we're going to hold through multiple busts and multiple bubbles over the decades of compounding it takes to create a super valuable company. However, when you look around at the moment, sure, plenty of stuff seems out of whack, but on the time frame that I think about, I don't care that much. In terms of trends, one trend that we're seeing that's I think affecting all startups now, at least in the Bay Area, is the competition for talent with the tech hypercaps is very difficult. So, when you have Google or Facebook finding the best engineers and putting these incredibly large compensation packages in front of them, how you as a startup attract enough talent, concentrate enough talent in your team to win, it's become a very hard question. In fact, that's become one of the first questions I ask startups. What's your approach to this?
Right.
Are you going to hire less people? Are you going to give them a huge amount of equity? Is the mission so important they're going to join anyway? And it is astonishing how many people don't have an answer to that question.
So how do they compete?
Oh, it's always different. Any of those things I just said are one approach.
Yeah.
But the problem is that most people seem to have not thought about it at all.
So just to put a fine point on it, you try not to think about whether or not we're in a bubble, but you think we could be in a bubble right now.
I think we are. I think some valuations are too high. I think some are too low. I think that if interest rates go up a lot, I think that probably has some ripple effect, I hope, on equity valuations. But I think I think it's not that binary of a question. It feels more likely to be true than it was in 2015. But again, there's still a lot of startups that I put a lot of money into at current valuations. So I just try not to. I'm not smart enough to figure that out.
Speaking of values, you recently suspended your role on the board of the Saudi Future City. Why did you decide to do that?
I don't have a lot more about it to say than I did before, but I feel way out of my area of expertise from what I can see. I have a lot of questions, and I'd like to wait for those to be answered, hopefully very soon, before deciding about my continued involvement in the board. In general, I believe you should always wait for the data to make any sort of decision, any sort of comment, but this case seemed to be exceptional.
Sam Altman there of Y Combinator and OpenAI. Speaking of that exceptional Saudi situation, as Altman put it, Saudi Arabia has pulled out of a planned deal with Virgin Hyperloop One. This appears to be in retaliation for Hyperloop One's founder billionaire Richard Branson freezing ties with the kingdom until more details are known about the alleged murder of the journalist Jamal Khashoggi. Officials in Riyadh have denied that Khashoggi, a prominent Saudi government critic, was murdered entering its consulate in Istanbul on October 2nd. Coming up, Forerunner Ventures has invested in some of the biggest cult-backed companies of a generation, including Glossier, Warby Parker, and Dollar Shave Club. Two partners join us to talk about the hottest trends they see coming next. This is Bloomberg. In the last year, retail e-commerce sales have topped $2.3 trillion, up almost 25% year on year. A growing number of startups are running with the trend, taking their business online and using consumer data to their advantage. But how to choose who to back? San Francisco-based Forerunner Ventures has already picked a few hits, including Glossier, Warby Parker, and Dollar Shave Club, and they've just raised another $360 million to back the next generation of e-commerce startups. Here to tell us more, Forerunner Ventures general partners Brian O'Malley and Yuri Kim. Thank you both for joining us.
Thanks for having us.
So $360 million is a lot of money. Where do you plan to deploy it? Yuri.
From day one, we've been looking to invest in the best
companies in commerce, and the $360 million fund is continuing to do that with the same thesis. So really thinking about commerce end to end. It's not only the products and services people buy, but where they're buying them, whether that's marketplaces or peer-to-peer sort of experiences, and then also the tools and technologies that power all of those business models on the back end.
Brian, you recently joined Forerunner from Excel. How did the fundraising environment differ from this vantage point?
Sure. So at Excel, we've been around for 35 years, and so we had a long history with several of our LPs, and so fundraising was more about going back to the well and continuing those relationships. Whereas at Forerunner, we're doubling the fund size, and so we wanted to go out and bring new folks to the table. And so we had this great opportunity to handpick who we wanted to work with and who we thought would be strategic to the firm.
So there's a lot of money out there. Multi-$1 billion funds have already been raised this year. Is there too much money out there? I mean, are you still seeing the opportunities in e-commerce, which is your focus, that you saw when you and Kirsten were there in the early days?
Yeah, absolutely. I think innovation's constantly happening, and commerce really is a broader set of opportunities than just e-commerce. Really, what kind of transactions don't have some digital component into it today? And so I think when we look at the landscape, we're even more excited about the innovation that's happening, how much the existing landscape is really transforming itself end to end. And the consumer today is more empowered and has more knowledge than ever before. So their expectations are growing. With that, there are new needs that that need to be met.
Amazon is threatening all e-commerce companies. So where do you see opportunities to invest in companies that aren't going to be eaten by Amazon?
Sure. So if you think about it, Amazon is now getting $1 out of every $2 online, which is a crazy high amount. But they play to certain strengths, right? So Amazon is all about convenience. It's all about timeliness. But they haven't been as strong around branded products. They haven't been as strong around services. And when we think about the companies that we're ultimately touching, several of them ultimately play in different markets. They might play in the pharma market. They might play in CPG. They might play in financial services. And so we think about Amazon a lot, but we also think about empowering companies that are competing with Amazon and companies that are playing in totally different markets.
SoftBank is deploying a huge amount of money into the tech ecosystem. The big story of the last few days has been connections to Saudi Arabia, a lot of their money coming from Saudi Arabia, and by default, a lot of tech money in the tech ecosystem coming from Saudi Arabia. Do you think that's a problem?
Yeah, I'll take that one. So this is something that we're all just digesting real time. Saudi Arabia has been putting money in the tech ecosystem for several years now, and they've been a strong supporter of the ecosystem. When we think about it, historically, founders haven't asked the question of where money's ultimately coming from. The end consumers of our companies haven't really asked that question. So this is something that we're all digesting real time as an industry. And it's something that we'll have to think about much harder going forward. Like, we take a lot of pride in our LPs and where our money comes from, but historically it hasn't been something that's been top of mind for founders, and we'll see if this experience changes that.
So do you have money from the Saudi government? Are some of your portfolio companies making these decisions as well, or considerations as well?
Sure, so we do not. And our companies, when it comes to SoftBank, the first question has been, is a fund like SoftBank the right fit? Is a large investment of hundreds of millions of dollars the right fit? And so we've been asking those questions for the last years now, because SoftBank has shown up with a very different value proposition than has been available to our companies historically. And so we've been asking those questions, and maybe it's been the right fit for some companies, maybe it hasn't. And this just adds another layer to the conversation that we need to be thoughtful about as we look at potentially partnering with them.
Now, Yuri, you joined Kirsten back in the day when Forerunner was really early stage, and it was, for a long time, all women.
Yes.
And then you made a decision to hire Brian. So talk to me about that decision. Was that a conscious decision?
It was a conscious decision, but I think it's worth going back and saying we never started the firm with the intention of having it be an all-female firm. Kirsten and I met, we had a shared passion. I was super enthusiastic about what she was building, and here we are. It was a team of women. It was 3 women. It was 4 women. And then we stopped and we thought, well, wait a minute. We're looking at the consumer. The consumer's diverse. We have some diversity around the table, which is pretty unique in our market, but we weren't necessarily feeling like we had all the voices represented, so we did. We actually thoughtfully decided we did want to hire a male participant to our team. We hired our associate KJ. That was a couple years ago. And then just last month, obviously, Brian joined our team. We have a new principal, Jason, as well. And so it's funny because I think when you start
your team with diversity in mind. It's going to evolve to that point naturally. And so we didn't hire anybody thinking about being a man or a woman, but just whether they were the great, fit for the job.
So totally unironically, and we only have 30 seconds left, but what do you bring to the table? Right.
Well, besides being a white guy, hopefully bring a few other things to the table. No, look, I've been in this industry a long time. I've got several perspectives, but I think most importantly, I bring a special relationship with the Forerunner team. We've worked together for over 10 years. We see the world in very similar ways, and we're really excited about what we can build with this new fund.
All right, Brian O'Malley, Yuri Kim, General Partners at Forerunner. Thank you so much.
Thank you
for stopping by. Great to have you. That does it for this edition of Bloomberg Technology. You can stay tuned right here on Bloomberg TV as we continue to cover Netflix results. The call about to start. To recap, Netflix added far more subscribers than analysts forecast in the third quarter and issued an upbeat outlook for the coming 3 months. More coverage ahead. I'm Emily Chang. This is Bloomberg.